This segment sponsored by Foster Financial. Welcome back to Women's Wealth Wednesday, where I'm chatting with Caleb Doan, the Vice President of Foster Financial. Good morning, Caleb.
Good morning.
How are you?
I'm doing well. How are you doing?
Good. Okay, so last Women's Wealth Wednesday, we kicked off a new talking series about spousal inheritance planning. And I know we have something that you want to add to it today. So what will we focus on?
Yeah, so today we'll specifically be talking about spouses inheriting IRAs. So traditional IRAs, which is what most people have. They typically get a 401k while they're working. A lot of times they roll it into an IRA when they're retired. And so that's one of the most common types of accounts for people to inherit. And there's a lot of rules around it. And those rules have kind of changed in recent years. We talked a couple weeks ago about how over the next decade, $30 trillion is expected to change hands.
Yeah.
And that's, mostly because the baby boomers are kind of well into their retirement now. And the reason why it's helpful to talk about on Women's Wealth Wednesday is because women are actually expected to be the largest beneficiaries of that. And so there's going to be a lot of money changing hands in the coming years. And a lot of times the government likes to get a piece of that when that happens. And so we like to plan for that ahead of time and try to reduce that tax liability any way we can.
Okay, and this is about specifically traditional IRAs or Roth IRAs also?
Yeah, so it applies to Roth IRAs as well, but the tax implications for a Roth IRA, taxes have already been paid on those. And so, hopefully when somebody is inheriting assets, a piece of that is Roth. That's what everyone kind of hopes for. But most of the time, the vast majority of it is traditional IRA. And spouses actually have kind of a unique option that they get to choose that almost nobody else gets. When kids inherit an IRA, typically they need to cash out and pay taxes on that entire account value within 10 years of inheriting it. And that's basically just because the government wants to get their piece of the taxes, right? So if a child inherits an IRA, they're typically needing to cash it out within 10 years. If a spouse inherits an IRA, they have another option. They get to inherit that IRA as if it was their own IRA. So they don't have to cash it out within 10 years if that's, the option that they choose. What they need to focus on is required minimum distributions over the course of their life. So if they are RMD age, they have to continue taking those RMDs.
Okay, so let's step back for a moment. So with the IRA, with those individual retirement accounts, this is if one of the spouses has one and the other spouse inherits it. So you're saying that they can inherit the IRA.
Yeah, that's exactly right. And IRAs, they're individually owned. So the IRAs cannot be joint accounts. And so a lot of times, a husband will have his wife listed as the 100% primary beneficiary. The wife has her husband listed as the 100% primary. And so whichever passes away first is going to get the other's account.
And so it sounds like you're saying it also still keeps the structure of an IRA, and it's not like a balloon investment in a sense where you just get a big chunk of money, but you actually still have to take those distributions, right?
Yeah, if somebody is RMD age, they have to take those. If a spouse that inherits it is not RMD age, the big benefit too is that they don't have to take RMDs until they hit required minimum distribution age.
Okay.
So I mean that's a nice benefit for spouses. One of the big mistakes though that a lot of people make is they assume that it's something like, kind of like that balloon reference where they have to withdraw all of it in the year that they get it. And if they do that, if they inherit a $250,000 IRA and they cash all of that out in the year that they get it, you're paying taxes on $250,000 in that year. And the other crazy thing is, if you're filing as a single filer eventually, I mean, your tax brackets are compressed now, and so that could kick you into a much higher tax bracket if you take a large withdrawal.
Okay, so let's talk about the benefits. What are the benefits in them receiving this IRA based off of a death, unfortunately?
Yeah, so I mean, of course, you get to continue using the IRA to generate income for you over the course of your retirement. So most of the time, if a husband and wife both have an IRA, a lot of times they're taking withdrawals in retirement to live off of. So you get to keep doing that is the really big benefit. A lot of times, pensions, for example, if they're only a single life pension, if somebody passes away, that pension might be gone. The payments
Yeah.
might stop. With an IRA, a spouse can continue to take those withdrawals. The biggest thing to just watch out for is going to be the tax implications. And so we can do a lot of things ahead of time to prep for that. When somebody is, married filing jointly, you have pretty wide tax brackets. And especially in retirement, a lot of times people are in a relatively low tax bracket. We can do Roth conversions ahead of time so that instead of getting that giant traditional IRA, you get maybe half traditional, half Roth, and then you don't have to worry about the taxes as much.
That's interesting. So how should spouses be preparing for this now? Because I think a big point that you said is that a pension could not be transferred or stop while you would probably want to leave a retirement account that they could actually access.
Right, yeah, exactly. The biggest thing, if spouses have a large traditional IRA out there, the Roth conversions can be a very, very important tax planning piece to do long in advance. But it's not necessarily too late to do it. If somebody's 75 out there and they think, oh, it's too late for me to get money into a Roth account, you can do Roth conversions no matter how old you are. And so it can be a great time to do those so that you don't leave your spouse in a difficult tax situation and you don't accidentally, put the government as a beneficiary on there. We don't want, as little as possible, we want to go to the government. As much as possible, we want to go to our spouse.
Okay, well, that's really good advice. We appreciate it, Caleb.
Yeah, absolutely.
And if you would like more information about Foster Financial, we'll have their website and phone number listed below to get your complimentary consultation. And I'll see you after the break. This segment sponsored by Foster Financial.